Hello and welcome back. My name is Patrick Boyle and this is class number 7 of 8 of Applied Portfolio Management. And so today's class we're learning all about alternative investments and in particular hedge funds. So yesterday we started in on alternatives, learning about private equity, and both today and tomorrow we'll be learning about hedge funds. And so we're going to learn what a hedge fund is, why people invest in them, and what the different strategies are and how those different strategies return. Okay, so let's get going. Well, alternative investments, just to kind of quickly recap a bit of yesterday's class, are investments other than stocks and bonds. So if we think of stocks and bonds as our traditional investments, alternatives are other investments that you could add in once you've already got a portfolio of traditional investments. So we include in there things like hedge funds, private equity, venture capital, commodities, all those types of asset classes that essentially might enhance return and might be uncorrelated to the traditional asset classes. And so we looked at this slide yesterday as well, and this is a breakdown of the asset allocation of 62 American university endowments with more than $1 billion in assets. And so it includes universities like Harvard, Yale, Princeton, and so on. And as you can see, they are about 45% allocated to equities, 12.5% allocated to fixed income, a little under 2% in cash, and the rest would be classified as alternatives. So as you can see, big institutional investors actually do seem to allocate quite a bit of their portfolios to alternatives. And within the breakdown of the different alternatives, the biggest slice here is hedge funds, which is 22.4% of this allocation. So that's what we're going to be learning about today. Now, it's worth noting that there's a bunch of different strategies within the universe of hedge funds. Like the term hedge fund there's not just one type of hedge fund. And actually that's why this class is broken down over 2 days, is simply there's so many strategies for us to go through, and we're trying to keep the classes roughly to about an hour long. So firstly, what is a hedge fund and why do people invest in them? Well, the idea behind the hedge fund is it's supposed to provide diversification benefit to an investor. Now, a lot of people think that the idea of a hedge fund is just that it's an investment strategy that's supposed to outperform the stock market, but that's not really the goal, because we'll say, for example, if a hedge fund was just a levered approach to investing in the stock market, so if the stock market was up 10%, your hedge fund was up 20%, and if the market was down 10%, your hedge fund was down 20%. The problem with that is that's an exposure you can get on your own anyhow, right? You can just lever your investment into equities if that's what you wanted. The idea of a hedge fund is it's supposed to provide some sort of excess return that's not explained by the returns of the market, and that's a return that we refer to as alpha. Now, a lot of people misunderstand the idea of alpha, and they think that alpha basically just means outperformance. So if a fund is up, we'll say 12% and the market is up 10%, they'd say, well, that's 10% beta and 2% alpha. Now, that's not actually what it means, because we calculate this by regressing the returns of the hedge fund against, or the investment strategy against the returns of the S&P 500. And essentially, alpha is the part that is not explained by the return of the market. So if there's just greater risk being taken, that's not alpha. Alpha is an excess return that is not explained by excess risk, at least excess stock market risk. And so hedge funds are supposed to give you this sort of positive return in excess of the market, and they're supposed to be uncorrelated to the market. So they're supposed to be able to give you maybe an up day when the market is down, an up year when the market is down, but equally in an up year or an up day for the market, you shouldn't necessarily expect a hedge fund to be up, because essentially the investments, and as you see when we go through the different strategies, there's not really a good reason to expect a hedge fund strategy to be correlated to the stock market, because usually what the hedge fund manager tells you they are doing is quite different to the risk that's been taken with a simple stock market investment. So The very first hedge fund, and actually how hedge funds got their name, was through this guy here, Alfred Winslow Jones, who launched his fund in 1949. And he did a certain amount of analysis around momentum and mean reversion in stocks, worked out how far stocks deviated from fundamental value using kind of corporate finance valuation techniques. But then the real innovation, of course, was that he bought as many stocks as he sold. So whenever he was long a stock, he was short another stock. So he had no real market exposure. So we'll say if he had a portfolio of long 20 stocks, he would then also be short an equivalent amount of money in other stocks that he thought were likely to underperform. And the whole idea behind this was that his idea was that he would give his investors access to his stock picking ability, but not really charge them for market exposure, because an investor can get market exposure anyhow. If there's a hedge fund and most of its returns are explained by the returns of the S&P 500, it's questionable value added by putting money into that, simply because you're paying a high fee structure for something that essentially gives you a return that is very cheaply available out there in the world. And so for Alfred Winslow Jones, he was in business for 34 years, and only 3 of those years did he have down years. And so this was quite a successful business, and many other people copied him. And so the whole hedge fund industry came about based upon the success of this original hedge fund. And so Winslow Jones originated the 20% performance fee. The traditional fee structure of hedge funds and also private equity is 2 and 20, meaning 2% fee of assets under management and 20% of the outperformance. And so he came up with this idea. He based it on the idea of what ancient sea captains used to charge people for transporting goods. And he thought, well, if it's good enough for sea captains, it's good enough for me. And so that's where that sort of 20% performance fee came from. And the idea of the 20% performance fee is that it's sort of supposed to align the fund manager's interest with the investor's interest. Now, it's worth noting that really up until recent years, a lot of these hedge funds were quite small. Up until around 2000, there weren't really very many hedge funds that had more than $1 billion in assets under management. Now today, $1 billion fund would actually be considered a small fund. But up until around 2000, that was actually a very large fund. Most of the funds were around $100 or $200 million. And what that then meant was that the 2% of asset under management fee, that really was just there to sort of cover the expenses of running the office. There's an expense of hiring in some staff members, getting some Bloomberg terminals and so on. And the 2% was meant to cover that. And then the 20% was meant to actually be the pay for the fund manager. Now, as time has gone on, the funds have gotten bigger and bigger. And so suddenly, if you look at some of these $20 and $30 billion funds, 2% of assets under management on its own is a rather healthy fee before even looking at the 20% performance fee. It's worth noting as well, though, that fees have come down. So 2 and 20 is sort of a headline fee that most fund managers would like to charge their customers. In the real world, that has come down and down over time, and it's often a little bit negotiable. In particular with startup funds, when a fund first starts, they'll often negotiate a fee with their first investors, basically in order to encourage someone to bet on them on day one. They might give them a fee break, and then as they become more and more successful, they get to charge this kind of high fee structure. So here's a quick look at what happens if you add a hedge fund into a traditional portfolio. So we've got here the returns of a 60-40 portfolio. So that's 60% of the money is invested in stocks in the S&P 500 and 40% in bonds. And we've used the Barclays Aggregate Bond Index as a index for bond returns. And so right here we've got the performance of just that 60-40 portfolio. Then we add in a quant fund. It's a quant futures trading fund that I've added in here. And what we've done here, so the second portfolio is 20% hedge fund, 40% S&P 500, and 40% bonds. So essentially, we've reduced the equity portion of the allocation and put some of it into our hedge fund. And so when we have the returns of adding the quant hedge fund, you can see that the returns are a little bit higher. The hedge fund is one that has outperformed the S&P since 2007. So that's kind of interesting and useful to investors to have outperformed the S&P. But as you can see, it's not by much. Like, we're going from a return of around 5.75% per year to a little bit over 6% per year. So it's a little bit better, but it's not that exciting, right? But what else is going on here? Well, this is annualized volatility of that portfolio. And so we've got a volatility or a standard deviation a little bit under 9% for our 60/40 portfolio. But when we've got 20% in the quant fund, you see that the volatility comes way down to, around a little bit over, it's probably around 5.5%. So that's a big reduction in volatility. And so that's actually attractive. Not only have you increased your portfolio returns, and even if you just kept your portfolio returns roughly the same, the fact that you've dampened volatility that much is quite attractive to an investor. And then finally, when we look over here, maximum drawdown, which is the high to low return of a given portfolio. For our 60/40 portfolio, we had a drawdown of, I don't know, it looks to me around 28% or so from high to low, while in the portfolio that included this hedge fund, and it's only 20% allocated to the hedge fund, we have a drawdown of around 15%. So that's almost halved the drawdown. So that's actually what's exciting and interesting about adding alternatives or adding a good hedge fund into your portfolio. It's not this enhanced return. Like, that's nice, that's good if it happens. But what's useful here is the reduced volatility, which you can think of as the risk of the portfolio. And that really is highlighted when we look at the maximum drawdown, where you can see what's happening. Now, why is this happening? Well, the reason is that this fund has roughly a correlation of 0 to the S&P 500. So that means that if the market is going up, that doesn't necessarily mean that this fund is going up. And if the market is falling, it doesn't mean that this fund is falling. So the returns of this fund are entirely unrelated to the returns of the market. And therefore, you get all of these additional benefits. And so that is why people invest in hedge funds. It's not just the idea of sort of excess returns. And historically speaking, it kind of was excess returns. Like, people didn't really know how to analyze these investments, and they just sort of found a guy who seemed to have really good returns and they would invest with him. But in the modern day and age, really, the kind of people who allocate to hedge funds are much more professional than they used to be kind of 20 or 30 years ago. And this is what they're looking for. They're looking to put together a portfolio that has good returns with good risk, and that doesn't really expose their investors to an awful lot of sort of stock market risk, which they're already exposed to. And so equally, a hedge fund manager should be thinking about this. If you're launching a hedge fund or thinking of launching a hedge fund, the correlation of your strategy to sort of easily available market benchmarks like a bond index or a stock index really do matter. Because if you're just giving someone sort of a juiced up version of bond or stock exposure, that's not really that interesting to a professional investor, because they kind of know they can get that anyway, right? Like, they can lever their investment into the S&P or into a bond fund or whatever it might be. So that is really what we're trying to do with a hedge fund. Now, it's worth noting that not every hedge fund does this. There's an awful lot of them out there that just give you an awful lot of beta exposure. So when I say that the world has grown more sophisticated, I guess I mean that certain people have grown more sophisticated. But there are a lot of people who are just excited by something that's up more than the market in an up year and down more than the market in a down year. And, hopefully, I don't care what they do, but I imagine over time they'll probably grow more sophisticated. So let's talk a little bit about the purpose of alternative asset management. So the real purpose, as I mentioned, is sort of to get this alpha rather than beta. And alpha just being, it's not outperformance, it's outperformance that's not explained by the return of the market portfolio. So it's sort of a return that's not available elsewhere. And that's how you get to charge high fees for an investment strategy. Is if you can give an investor something that they can't get somewhere else, right? If something's cheaply available elsewhere, well, then they're going to buy the cheap version, right? And other benefits are diversification and this lack of correlation. And of course, diversification and lack of correlation really overlap. They're very similar concepts. Okay, so let's move on. So hedge fund strategies, there's a whole bunch of them. And the ones we're going to look at over today and tomorrow are merger arbitrage, statistical arbitrage, equity market neutral or relative value strategies, convertible bond arbitrage, fixed income arbitrage, macro trading, managed futures or CTAs, volatility arbitrage, capital structure arbitrage, and index arbitrage. So that's sort of a good list of the types of strategies that are out there. Now, of course, there's many more strategies, but that's quite a lot to go through over, 2 one-hour classes. And we'll try and go into a reasonable detail and explain how these things work. So let's firstly look at hedge fund performance and even why the hedge fund industry exists. So what we have here, this is a chart from 1997 through to present of the HFRX Global Hedge Fund Index. So it's an index made up of a bunch of hedge funds. Probably the HFRX are the ones that are actually available to be invested in. There's HFRI and HFRX indexes, and the I ones are closed to new investors. So X is more interesting because it's what you can actually buy rather than the ones you can't get into. But anyhow, so the heavy blue line there is the HFRX Global Hedge Fund Index. And what have we got here? And the blue line here is the MSCI World Stock Market Index. So it's sort of a big benchmark index of global equities. And so as you can see here, the HFRX, the hedge fund index, has gone up a bit more than the stock index. But what's interesting, let's look at the chart in a bit more detail. As you can see here, from 97 through to about 2000, the two of them were going up roughly in line with each other. In 2000, there was the whole dot-com meltdown, and we had 3 down years in the stock market. And so you can see here this 3-year sell-off of stocks. And over the same 3-year period, the hedge funds seemed to make money. And that's when hedge funds went from being a really small industry into quite a big industry. So I actually started in the hedge fund industry around 2000, and I worked for a hedge fund that at the time we returned about 50% a year over those 3 years when the stock market was going down. And so what happened basically was that this was an industry that no one really had heard of around the turn of the millennium. And there was good performance when the market did badly, and that got investors interested. And so suddenly everyone wanted to invest in hedge funds because they said, well, I need to invest in the kind of thing that can go up when the market goes down, because the market sometimes goes down. And so that's when the hedge fund industry went from these sort of $100 to $500 million funds into multi-billion-dollar funds. It got huge. And so as you can see here, afterwards, a bit of an interesting thing is that there's a very strong relationship between the returns of hedge funds and the MSCI Global Index after that. And you might ask, well, what's going on there? Like, how come on the next sell-off here in 2007, 2008, like during the financial crisis, why didn't the hedge funds make money when the stock market went down? And my answer to that is they were different hedge funds, right? Because when the industry got awfully hot and essentially there were much higher fees being earned by hedge funds than mutual funds, almost everyone who ran a mutual fund decided that they were now a hedge fund manager. And so I would argue that the whole industry changed quite a bit. And as we go through these, the returns or the strategies, you'll start to see that we'll even say the simple idea of long short equity, right? Where you've bought some stocks and sold some stocks. There's no reason with a hedged return like the Alfred Winslow Jones portfolio that the hedge funds would sell off. They sold off less than the market in general. Like, they did all right, but there's no real reason for this high correlation if you were actually long and short stocks. And so the takeaway possibly is that there's maybe as more and more assets came into the industry, it became more and more correlated simply because there was less room to do these kind of fancier trading strategies. And also people just didn't necessarily want to. They were able to charge high fees by sort of saying, well, I'm really good at analyzing stocks and I'll put you in the good ones, So that is, that is the returns of hedge funds versus a stock index. And then the green line that's in there is the fund of funds index. And a fund of funds is actually a fund that invests in other hedge funds. So if you were nervous about picking which strategies or which managers you wanted to invest with, you used to be able to go to a fund of funds and you'd say to them, well, I'll give you a certain amount of money and you put that into a basket of what you think are the good hedge funds. And so that was a big industry for a while. As you can see, it has underperformed the hedge fund index, but that's just because there's two levels of fees, right? The hedge fund manager is charging fees and then the fund of funds manager is charging fees. So you'd expect the returns to be a little bit lower. The fund of funds industry didn't do very well through the Bernie Madoff scandal back in 2008 because it turned out that an awful lot of them, they told their investors they were doing all of this deep analysis of the funds they were investing in and all this due diligence and that they knew better than their investors as to what to pick. But then it turned out they put an awful lot of money with Bernie Madoff, who was running a huge Ponzi scheme. And so that industry became a little bit disgraced, and also people were annoyed by the underperformance due to the fees. And so today that is an industry that does still exist, but it's an awful lot smaller and it's changed quite a lot. So are hedge funds a good investment? Well, we've looked at some returns and we've talked a little bit about this. And often you read in the news, I've grabbed kind of a couple of articles here, the strange death of fund of hedge funds, hedge fund returns. It's all of these, the most fascinating investing paradox. And this is written by a guy called Barry Ritholtz, who encourages people. He charges them a fee to put them into index funds, which I think is maybe a questionable business. But anyhow, he writes about how terrible hedge fund returns have been over the last decade and how people shouldn't invest in them. And CalPERS, one of the big pension funds in California, a few years ago pulled out of hedge fund allocation. So the question is, are they a good investment? And we'll have to talk about that because in certain ways, some of them are and some of them aren't, right? And so the question then is, can you pick the good ones, or are you just allocating to a high fee asset class? Let's see. The first thing I have to talk about here is the term arbitrage. And the reason I have to talk about arbitrage as a term is that it's a term that is kind of horribly misused by the hedge fund industry or by the trading industry. Now, the term arbitrage, at least from an academic perspective, means sort of a risk-free return. So the idea is that you're simultaneously buying and selling an equivalent asset in two venues and that there's no time lag, and essentially it's a risk-free return, right? And so that's what's meant by academics when they talk about arbitrage. Traders often talk about arbitrage as just being kind of a good return stream that they found, So none of the hedge fund strategies that we talk about, they'll all have things like fixed income arbitrage, convertible bond arbitrage. They'll often have the term arbitrage in the name of the strategy, but that does not actually mean that there's any arbitrage in there. In fact, I'll tell you, there's not. And the truth is, why is there not an arbitrage in there? Well, if there is an arbitrage out there, all of this money is chasing it. You'd expect the returns to disappear to zero. There's no one who's going to walk away from a risk-free return, right? And so arbitrages don't exist, but little interesting trading opportunities might exist, or trading strategies that give you a return that's unrelated to the S&P 500 or the return of bonds might exist. And so these strategies might give you an attractive return stream, but that does not mean they are an arbitrage. And as you'll see by the returns that we look at, they have plenty of up and down periods. And if it was an arbitrage, there'd be no down, right? So let's take a look at a few of them. So the market neutral idea. So why would anyone trade? We'll start with sort of the most simple idea, the kind of Alfred Winslow Jones approach as to investing in a long short hedge fund, a market neutral hedge fund. And so if this is the returns of the market, the stock market over time, and we've got this wiggly line that goes up, and this is time at the bottom. Any investment in this is what we call a beta return, and basically you're getting the return of the market. Now, you can get a high beta return if you invest in riskier stocks. You might get higher return, but with a similarly higher risk, right? And so that's still beta. There's no alpha in there. Alpha is this idea where it is outperformance that is not explained by the moves of the market. So it's not just outperformance, it's outperformance that is not explained by the movements in the S&P 500. So that's what alpha is. Now, if you invest in a mutual fund, for example, a long-only investment vehicle, and you get this outperformance, you're getting this blend of alpha and beta. Most of your return is the return of the market. And if the fund manager is a particularly good stock picker, you're getting maybe an excess return above what you would expect. And that's great. The problem is we can also get negative alpha, right? And so that is underperformance that's not explained by reduced risk. And so with underperformance like that, we've got negative alpha, and so a mutual fund or a long-only investment strategy can give you that as well. And often you do get that simply because there's a fee structure associated with most investment management products, in fact with all investment management products. And so an investor will over time usually underperform the market, and that's to be expected. There's often this big criticism where people say, why do fund managers on average underperform the market? And they sort of have to, right? Because if you add up all of the fund managers out there, like every fund out there, then you've got the market, right? Because they'll all be overall, if you add up all their long exposures, they'll be the exposure of the market, and then they are going to underperform because you've got all of them. And so best case scenario, you'd get the average performance of the market, but of course they're all charging a fee, so they're all on average going to underperform by the amount of the fee. And so that's the argument for indexing, or for finding the lowest fee product possible, because that's a way of possibly getting better performance than in an average mutual fund. So alpha, the calculation of alpha, was first used as a measure to evaluate mutual fund managers by Michael Jensen in 1968. So it's often also referred to as Jensen's alpha. And as I said, it represents the abnormal return of a security over the theoretical expected return. And we've got a calculation down here where alpha equals portfolio return minus risk-free rate plus portfolio beta times market return minus risk-free rate. And so that is alpha. So equity market neutral or long short, that's sort of two names for the same sort of idea. Market neutral means that the returns of this strategy should be unrelated to the market, and it's because they're long some stocks and short some others. Now, there's a few ways of doing this. You can be long positions in stocks versus equity index futures. So you can just choose stocks to buy and then hedge out your market exposure using futures. You can just find stocks to sell. So you can maybe feel you're good at finding the bad stocks. You can find a basket of stocks to short and then go long equity index futures in order to hedge that. Or you can pick both good and bad stocks. So you can go long positions in the good stocks and short positions in the bad stocks, and hopefully get a good performance out of that. Or finally, you can be long positions in stocks or ETFs versus short position stocks or ETFs. So sometimes they'll use ETFs rather than futures in order to hedge. And so that is the idea of long, short equity or equity market neutral, whatever you want to call it. And so, as you can imagine, you wouldn't expect this to have a return that is highly correlated to the market if the fund managers are really doing what they say they're doing. So how do they pick the stocks to go long or short? Well, usually they'll use, there's a bunch of different things they can do, and they all do different things, and they'll all tell you that their way of doing it is the best. But they can use methods like discounted cash flow methods, comparables, they can use statistical analysis, they can look at anomalies, they can use technical analysis, they can do, they can have sort of a macro overlay that helps them decide what to buy or what to sell, market timing, economic analysis, all these things. So there's many things that they can do, but they essentially are doing sort of usually fairly traditional security selection, but instead of just giving you access to the long only stream of returns, they're giving you a hedged return. And so in a market sell-off, you would hope that these funds would hold up. Now, when we look at the returns of this is the HFRX Equity Market Neutral Index. That's the heavy blue line. And the light blue line, there's the S&P 500. And the problem we're seeing here is that in the long run, this is from 1997 until present, these strategies haven't really performed very well at all. In fact, they're really just sort of sideways over the whole period. Fixed income investments have outperformed them. So as an overall strategy, like as a basket of hedge funds, these things haven't really done awfully well. I guess the one good thing about them is that they are sort of, at least as a group, doing what they say they're doing. They're not exposing you to the S&P 500 simply because they don't seem to have a very strong relationship to the returns of the S&P 500. But the problem in here is that maybe the returns, at least if you just picked a fund at random, you might expect a return of next to nothing over a long period of time. And of course, you're paying fees over that period. So that's, that's the returns. So next thing up, we'll talk a little bit about convertible bonds. So I'm going to tell you what a convertible bond is if you don't already know. And then we're going to learn a little bit about convertible bond arbitrage. And it's an interesting study as well. So convertible bonds are a type of bond that can be converted into equity at the owner's option. So you get to choose if you'd like to. You buy a bond, and we'll say if the stock did awfully well over the life of the bond, you can convert the bond into equity, and then you own stock rather than a bond. And so that is what we call a hybrid security. And if you're interested in more on that, I do have a YouTube video on convertible bonds. But anyhow, the conversion from being a bondholder to a stockholder is optimal only above certain share prices for the company's equity value. So that's what a convertible bond is. How can we look at them? Well, the minimum value of a convertible bond is the straight bond value, right? So if the stock doesn't go up at all, you still have the return of owning the corporate bond that is, partially what you've got when you invest in this. Now, usually a convertible bond will pay a lower coupon than a straight bond equivalent, simply because the whole reason that the company issued this convertible bond is usually in order to reduce the interest they have to pay. So they wanted maybe to issue bonds. The bank they went to said to them, well, the interest rate you have to pay is a little higher than maybe you were hoping. And they said, well, what can I do to reduce that interest? And the answer is maybe you can include this convertibility feature in there. And so the right to become an equity holder is a warrant. Now, it's not. It looks a lot like a call option, and once again, I have another video that explains the difference. But it's not a call option; it's a warrant, and that's because of this whole dilution issue that happens with convertible bonds. But anyhow, you can value a convertible bond as being part straight bond value and part this conversion value, the value of the warrant. So convertible bond arbitrage then is a trading strategy that's built around these convertible bonds. So if the company has listed equity options, if there's options out there, if there's call and put options out there that you can trade, and regular bonds as well, so non-convertible bonds out there, you're basically able to trade this convertible bond against them. So you can basically buy up the convertible bonds, you can hedge out all of the other risks, and you're left with this warrant. And the warrant is an awful lot like a call option. It's slightly different, but it's similar to a call option. And so you're then able to trade the warrant against the value of listed call options that are out there. And so if these bonds are being issued too cheap, essentially you're getting a cheap warrant, and that is the whole trading strategy, is extracting that sort of cheap option from the bonds. And so any kind of deviation in the price of the convertible bonds from the listed products that are out there, the stock or the bonds or the options, allows you to hopefully extract some sort of arbitrage-like profit. Now, as I said earlier, it's not an actual arbitrage, but it's arbitrage-ish, we'll say. So convertible bond arbitrage. So if there's a convertible bond, there's the public equity, there's a straight bond, and there's publicly listed options. There are all sorts of opportunities, at least in theory, to profit from deviations in prices between any of these four financial products. And so that is what a convertible arbitrage hedge fund tries to do. They try and find out which of these features is the cheap feature in there, and then they try to extract that cheapness. They try and get, usually it's the warrant that is cheap, and they try and extract this sort of cheap optionality from convertible bonds. A lot of the opportunity in this space arises at issuance. And so what really happens or happened was that the investment banks that issue these bonds, in order to, when you're issuing a bond, you've got a big float of these bonds in order to try and get out there into the market. And usually they'll try and give a good price on the bonds in order to sell them all, because they don't want to be left, with half of the bonds on their books, right? And so you're trying to sell these, and maybe you try and sell them at a little bit of a discount. And at that point, a convertible arbitrage hedge fund would step in and maybe buy most or all of the bond issue. They try and get a lot of them, right? Because if there's a cheap option out there, you might as well get as many of these cheap options as you can. And so often companies issued these bonds at a discount in order to attract investors, and they did attract investors, and they were these convertible bond arbitrage traders. Now, the problem with that is that, as more and more traders come, like as this strategy does well, you'd expect more and more people to want to buy these convertible bonds, and that doesn't mean there's more and more of them available, and definitely not available at a good discount. So this is not necessarily that scalable a trade. You might be able to do it well with a certain amount of money, but the more assets you get under management, the less convertible bonds, or at least cheap convertible bonds, you'll be able to find to trade in this manner. And so this systematic underpricing of new issues did give rise to artificially low embedded warrant prices. So that was what happened, and the traders would buy the convertible bond, sell listed call options on the company's shares, and wait for the two prices to converge, or they just hold them until expiration. Either way, they would extract the cheapness in the warrants that were in these convertible bonds. Finally, this is my last slide, and hopefully you noticed that this is a convertible bond. It's James Bond. But anyhow, there's many ways to trade this. You can be long the convertible, short the bond, short call options, long the convertible, short shares at a conversion ratio. There are also lots of risks involved in this strategy. So like I said, the term arbitrage, loosely used. They're often highly levered, right? Because as you can imagine, the problem with this sort of underpricing of the bonds is they're not ridiculously underpriced. They're just a little bit underpriced. And so if they're just a little bit underpriced, but you need to get a respectable return out of them for your investors, you of course need to lever into this trade. So that's what happens. Other things like early callability in bonds or special dividends can affect the returns on this strategy. Famous hedge funds out there in this space are Ken Griffin at Citadel. Ken Griffin is sort of a great hedge fund story. He actually, I think, started trading this strategy from his dorm room at Harvard. I believe he had to install like a satellite dish to get internet access in order to trade this. This would have been in the probably early 1990s, when having internet access would not have been a thing at the dorms in Harvard. A bunch of other funds, Basso, CQS, Pine River. But Ken Griffin was kind of one of the really early successes in this space. And so what essentially happened was Ken Griffin was very successful with this. He raised a lot of money. An awful lot of other people also started mimicking what he was doing. And this is what happened to the returns. So as you can see, there are very good returns that were unrelated to the market up until about 2001, 2002. After that, it kind of went sideways for a long time. Then a big sell-off during the credit crunch, which was not good, and then a bounce back. But the bounce back was just because it was sort of oversold off at the time. So what's the lesson of this? Well, the lesson is that it was an interesting strategy. Maybe someday again it will be. But the real takeaway here is that around the time I actually started in the hedge fund industry, every new fund, I traded a quantitative futures strategy, but almost every new fund back in the late 90s, early 2000s was a convertible bond arbitrage fund. And it was simply because Ken Griffin and a few other funds had been so successful at the time. And this is often what happens with good trading strategies, is if it does well for a while, people start to notice it, they all pile in. And so we'll say maybe, this good performance might have been happening with a couple of $1 billion, and then suddenly you throw 50, 100 billion at it, and there's no longer cheap convertible bonds out there, and the strategy doesn't work anymore. Now they keep trading it because they're been paid 2 and 20, right? So they're probably not going to earn the 20 because it's not going to perform, but they can get your 2 from you, right? And so the problem is that sometimes, any sort of strategy like this, there's usually only a certain size that it can be traded to, and then after that it becomes really a break even or possibly a negative expectation trade. So that is convertible bond arbitrage. Okay, so our next strategy up is fixed income arbitrage. And this involves finding small mispricing between different bonds that are out there. And so there's a bunch of different ways that this can be done, and I can't go into too much detail in this quick video, but actually if you are interested in this strategy, and it's kind of a great story, I think I mentioned in video 1 of this series, the book When Genius Failed, and it's all about long-term capital management, which was a hedge fund in the late 90s, just late 90s. It went bust, I think, in 98. So kind of early to mid 90s, I guess. And their big trade was fixed income arbitrage. And so you can kind of read up on that. It's an interesting and a fun story, and there's tons of great lessons in there for investors, and you'll learn quite a lot. It's almost the book I can think of that you'll learn the most about the hedge fund industry from. But it's a highly mathematical area. So a lot of the kind of people in this area, they're not sort of mildly quantitative, they're really quantitative, because essentially quantitative people quite like bonds, because bonds have this sort of contractually guaranteed, or at least hopefully guaranteed, cash flows. And if you're quite mathematical, you can build up all of these models that match one cash flow against another, and you try and find cheapness in that space. And so the big trade that we'll talk about right now is this on the run, off the run trade, which was the big trade of long-term capital management. And it is kind of what people think of when they think of fixed income arbitrage. Now, the issue with this is that you're usually capturing really small returns. And so then you find, they're low returns, but usually low volatility, and therefore the funds have to be really highly levered. And by that I mean often more than 20 to 1 leverage into this trade to get even half decent returns out of it. So the on-the-run, off-the-run trade. So an on-the-run bond is the newest issue of a given type of bond. So we'll say, for example, if the U.S. Federal Reserve, if they issue a new treasury once a week, we'll say, the newest one, the one they've just issued, is the most liquid one, right? Because it's the one that's just out there. And what happens is the dealers buy up that bond usually from the Federal Reserve, and then they sell it on to other people. But eventually what happens with bonds is they might move around a little bit in the first few days, and then they end up with the investor who plans on holding on to them until maturity. So they're liquid enough to begin with, and then they're illiquid after that, and they're very hard to buy and sell. They're not like stocks that can be bought and sold constantly. And so that's the on-the-run bond, the newest, most liquid one. And the off-the-run bonds are just the previous issues, the ones that are out there already, with maybe odd terms to maturity. They're, instead of being the 1-year bond, they're the, 8-month bond, or, it was a 1-year bond and now it's an 8-month bond remaining. And so it's just a little bit harder to buy and sell, simply because the kind of people who want it have bought it and they already have it, and they're not selling it, and it's harder to trade. And so the idea is that on-the-run bonds usually trade more expensive. They're more expensive simply because they're more liquid. And so what people do is they sell short. What a fixed income arbitrage trader does is sell short the on-the-run bonds and buy the off-the-run bonds. So what are you exposed to there? Well, there is a pricing difference that you're hopefully trying to extract, but what's driving that pricing difference? And the answer is it's kind of a liquidity premium. So the on-the-run bond is more expensive, but it's more expensive for a reason, and that's tied to the fact that you're able to buy and sell it easily enough. The other ones are cheaper, but they're cheaper because they're harder to get in and out of, right? And so essentially this strategy is trying to extract a return from liquidity premium in the market. So what happens here? So basically you're short the on the run, long the off the run bonds. Usually you might find yourself trading two different off the run bonds against a given on the run bond. And the reason for that is that you have to match up the duration of bonds. And I explained duration in an earlier class, the portfolio management class on fixed income. So if you don't understand that, go and look at that. But so often you might have to trade two different bonds in order to match the duration, in order to have a reasonable hedge in place. So the risks of this strategy, well, you're usually capturing tiny returns, right? They're tiny returns that you're capturing, and so you have to lever it up. And then in periods of market stress, you can have horrible mark-to-market losses. And that's what happened with long-term capital management. And not only that, some of the principals of long-term capital management went on to launch another fund actually shortly after long-term capital management liquidated. I think it was called JWM Partners. And I believe they had a similar situation occur to them during the credit crunch. So the problem is that in moments of market stress, this type of strategy, it's not that it does badly, it does maybe horribly, you know. And you're always in a sort of dangerous position whenever you're highly levered, because someone else is able to force you out of the trade, right? Whoever is providing that leverage is maybe able to take it back from you, and then you have to liquidate. So it says here at the bottom that if you're not too levered and you're able to hold the position until expiration, you might still extract that profit. But the problem, of course, is that usually that's not the case, or at least that hasn't been the case necessarily in the past. So that is fixed income arbitrage. It is worth reading the story of long-term capital management. You can either just look up the Wikipedia page of it, or you can I really would recommend the Lowenstein book, When Genius Failed. So the returns of fixed income arbitrage we have here, and so this is the meltdown in '98 due to long-term capital management going under, and over here we have the credit crunch. Now this isn't a log scale chart, so actually they're really actually equivalent in terms of drawdown, but as you can see, it kind of provides quite steady returns until it doesn't, and then it gives you a horrible return. One of the things that happened at long-term capital management is they were one of the first groups of people to come up with this trade. You know, this was sort of their thing. Originally at Salomon Brothers, and then they launched a fund in order to trade this strategy. So it's kind of a new strategy at the time, and they didn't really know how it would work out. And they went through a period of very low volatility in this strategy, and their goal was to get about the same standard deviation or volatility as the S&P 500 in their fund's returns. And so there was really no volatility at all, so they just kept upping the leverage to the point where they were getting volatility, and that's when the Russian debt default occurred, and that then caused this huge sell-off, and of course the fact that they had to unwind these positions exacerbated that. And so that was kind of a longer term chart of the Credit Suisse fixed income arbitrage hedge fund index. This is more recent return, so we've got what have we got? 2016, a return of 5.6%, then around 4% the next year, 0.43% the year after, 2.42% the year after that, and up until February of this year, 2020, we've got what is that 1.16% return. It'll be interesting to see what March's returns look like, because they're possibly not that pretty, but I don't have access to that at the time of making this video. So this is the returns of long-term capital management, the blue line, the Dow Jones Index, and the US Treasury. So as you can see, on the run-up from around 94 through till 97, long-term capital management had just huge outperformance. I mean, this was, just to be clear, the biggest and the kind of what was viewed as the best hedge fund in the world at the time. And this was I think a multi-billion-dollar hedge fund at a time when hedge funds were not multi-billion-dollar funds. So this was the biggest and viewed as the best hedge fund. It employed people like Myron Scholes and Merton of the Black-Scholes Merton option pricing model. You know, so that's why the book was called When Genius Failed, because while they were employed by long-term capital management, two of the partners won the Nobel Prize for Economics. So as you can see here, just really high returns, you know, no obvious correlation to the Dow Jones Index. And then, you know, it all fell apart, and we've got just this massive loss, you know, where they lost more money than they started with, or than they ever created within the fund. And so that's long-term capital management. So then we'll move on to macro trading, and macro trading is kind of a well-known hedge fund strategy. And the problem with macro trading is that it's not a very well-defined hedge fund strategy. So often when people say they're a macro trader, it's very difficult to know exactly what it is they do. But the most famous of the macro traders is George Soros. In fact, he's the guy who sort of coined the term macro trading. And so there's a huge variety of different styles. And in truth, a friend of mine who invests in hedge funds said to me a few years ago that his way of thinking of macro is that if it doesn't fit into any of the other baskets, you can call it macro. So it's kind of a bit of a loosely used term. So macro traders can take views on relative performance of country, equity index, foreign exchange performance, commodities, volatility, that sort of thing. And so really the idea here is that as a macro trader, they're kind of trading country performance rather than single stocks. So they're not really choosing which stock will do well, but they're sort of saying, I think Sweden will outperform Norway, or you know, they have a view on how Brexit will work out or something like that, and will be doing macro trades based upon you know, these big macro trends that are out there. They can be discretionary or systematic. So discretionary means that it's a guy who just comes up with his idea of what he wants to do. Systematic means that there's some sort of quantitative system in place. Usually all of these people, at least the ones who are good at it, will have extensive modeling and analysis to arrive at views. So it's not sort of a seat of the pants type of trading as many people might think. It's usually, at least the people who do well, have very sophisticated and well thought out approaches to investing. The famous trade of George Soros's was this trade in, I think, was it 1992? 1992, when he's referred to as the man who broke the Bank of England. And so the big macro trade leading up to this was sort of the convergence of currencies in Europe, right? Because essentially in the lead up to the formation of the euro, every country in Europe had a different, free-floating currency, and they fluctuated relative to each other. But the idea was, under the ERM, the European Exchange Rate Mechanism, they had to sort of converge their currencies together in order to then be converted into the euro. And so they were kind of pegged to each other, and or they were trying to converge. And so a lot of macro traders made money just betting on this convergence. The central banks of all of these countries said they were going to converge, and then they made it happen. And so that was the big macro trade of the late 80s, we'll say. And so by 1992, what was happening was that Britain had pegged the Deutschmark. I think it was John Major kind of pushed that the British pound was pegged to the Deutschmark at 2.7 marks to the British pound. Now, basically, they wanted to come in with a very good valuation to enter into this. And Britain had low interest rates and high inflation. So this was problematic. So Britain was not really able to maintain this peg. They'd pegged in at the wrong level and it wasn't working. And it wasn't just George Soros. Like, if you read the news at the time, they act like one guy did this. But essentially what would have happened is that every company that was out there that was trading within Europe, and by that I mean like I don't mean a hedge fund or an investment bank, I mean people buying and selling goods, would have worried maybe a little bit about the exchange rate between the pound and the Deutschmark. And as it started to slip, or as it got shaky, they would have hedged their exposure. Now, George Soros did see what was happening. He saw what was wrong, and he started to put on a very big trade. And at the time, it was even in the news. They said there's this awful speculator in New York who's trying to, knock down the pound. And I think, the British politicians all came out and said this would never happen. And then a couple of days later, they had to devalue the pound. And so George Soros made $1 billion in a day, which back then was a lot of money. And George Soros became known as the man who broke the Bank of England. Now, in truth, George Soros says that he was a bit disappointed because he didn't have his full-size trade on. He was only scaling into the position. He didn't think it would happen as quickly as it did. So he sort of hoped to make more on that trade than he actually did. But sort of after that, well, not just because of that, because of a very long track record of great returns, George Soros is kind of almost the biggest hedge fund legend that there is. And so that's the story of breaking the Bank of England. And you can Google that and learn more if you want to. So the next thing up is the area of managed futures, which are also known as CTAs. And that's actually the fund that I manage would be classified as a CTA. And so we've got here, usually a CTA can only trade derivatives. So you're not allowed to trade stocks and bonds. You have to trade derivatives. So that's usually futures or options. Maybe other things like swaps can be in there as well. Usually they trade directionally. Now, they don't have to, but often you find that they do. They can have no leverage up to being highly levered. Often you'll find that they're trend following. An awful lot of the big CTAs out there are what are classified as trend followers. And that's kind of a very well-known strategy in the world of investing. Often multi-asset class. So they're often, even the name CTA stands for Commodities Trading Advisor. And so often they're trading all sorts of commodity products as well. So they might be trading gold and corn and wheat and whatever it might be, frozen concentrated orange juice, for example, and all of these other products, along with financial futures like S&P futures or bond futures, foreign exchange as well. And they have a different regulator than hedge funds. So they are regulated by the CFTC in the United States rather than the SEC, which regulates hedge funds that trade stocks. So essentially they get a different regulation regime by agreeing not to trade stocks, which are regulated by the SEC. So famous managed futures funds, there's a whole bunch of them: AHL, Winton, Cantab, Blue Trend, Systematica, Aspect Capital, Two Sigma, Crable Capital Management, RG Niederhofer. These are all kind of well-known managed future funds. And so for some reason, an awful lot of them seem to be based out of London. I think that's tied to Man AHL, which was a London-based fund. And then a lot of the guys who spun out of there founded firms like Winton and so on. And so that is managed futures. This is the returns of the Barclay CTA index. And as you can see, this is 1981 until present. And as you can see, kind of very good steady performance for quite a long time up until, around 2009. And in fact, these funds did awfully well during the credit crunch. They were probably the only strategy that really was up a lot during that period. After that, it's sort of been sideways to up slightly. So over the last decade, they've underperformed the S&P 500. One of the things I would say about this group of funds is, once again, at least they're kind of doing what they tell their investors they'll do. They're not highly correlated to the S&P 500. Often there's a lot of people who refer to CTAs, or in particular the trend following funds within the mix of CTAs, as being what they call crisis alpha, which means that often they pay off, they have good returns when other things have bad returns, like during financial crises and so on. And so it'll be a little bit interesting to see how things work out at the moment during this whole COVID-19 lockdown. We do have some data. So this is the returns of the Abbey Capital Future Strategy Fund, Class I. And so Abbey Capital is a Dublin-based mutual fund company, and they essentially invest in an awful lot of CTAs, usually through managed accounts, and retail investors are actually able to invest in this. And so the blue line there, this is actually right up to date. This is up until Friday. The blue line there is the year-to-date return of the Abbey Capital Futures strategy, and I think they're up around 4.2%, with the S&P down about 21%. So that's the recent returns. That's the year-to-date returns. Now, in truth, over the last couple of years, as I've said, a lot of this stuff has gone sideways, but maybe we'll see how it does in an environment like this. So the next thing up is volatility arbitrage. And so volatility arbitrage is a hedge fund strategy that's based around trading options. And so when you trade options, you're exposed to either let's think about the things that go into the pricing of a financial option. There's usually the price of the underlying, and then the volatility of the underlying, and a bunch of other factors, but there are big factors. And so if you hedge out the directionality of the underlying, if you hedge your exposure to the price direction of a given stock and you trade an option, you're then mostly exposed to its volatility, to its standard deviation. And so you can be profitable if you are better at predicting the volatility of a given underlying than the market in general is. And so there's a whole bunch of analysis involved. They're called volatility funds because they're usually trying to trade volatility rather than the direction of these options, or the stocks or whatever that might underlie the options. And so there's a bunch of different types of analysis they can do. It could be fundamental, technical, economic, quantitative. There's all different ways of doing it, but they express their views by trading options, and usually trading the option against the underlying stock. And so the idea is to trade a delta neutral portfolio of an option against its underlying. Now, once again, I've put up a bunch of videos on this topic already on YouTube. So if you want to learn more about this, you can look at those videos. But the idea is that they take advantage of differences between the implied vol of an option and the investor's forecast of future realized volatility. So the implied vol being volatility, the implied volatility of an option is what the market thinks standard deviation is likely to be over the life of the option. And if you have a different view, if you think it'll be higher or lower, you can then trade the option against the stock in order to just be trading the volatility. And basically, they try and buy volatility when they think it's cheap and sell volatility when they think it's expensive. Now, often they might be trading single stock vol, they might be trading index vol, they might be trading one against the other, they might be doing all sorts of correlation trades as well. There's many ways of doing this. The people who trade volatility arbitrage tend to be very smart, very quantitative kind of people, because there's a lot of mathematical modeling involved, and even just understanding options, it's quite technical. It's not like building a DCF model. It's maybe significantly more technical. And if you're interested in that, I do have videos on that topic on YouTube. Basically, because the trade is not directional, it doesn't matter if you use calls or puts. So there's two types of options, call options and put options. And it doesn't matter which one you're using because you're usually not trading directionally. And so the trader will basically either be buying or selling options in order to get long or short volatility, hedging their market exposure by trading the underlying or even a different option against the initial option. And the trader will make a profit if the underlying's realized vol is closer to their forecast than it was to the market's forecast. So that's the idea of this strategy. And as I said, there is a YouTube video on my channel if you're interested in learning more about this. And other things that they can do. So you don't just have to trade options. They're also able to trade volatility or variance swaps. And I have a video up explaining what those are as well if you are interested. But this is a swap type product that gives you exposure to the volatility of a given underlying. So what have we got here in terms of returns? Well, once again, uncorrelated returns, kind of steady. Didn't do that well during the financial crisis. Once again, the problem is that, often there's a certain amount of tail risk in these strategies. And so when tail events occur, performance can be bad. As you can see here, we have a black swan event. And, and so there was a big sell-off during the credit crunch and then a recovery. But, that is volatility arbitrage. So our very last strategy of the day, and then we'll wrap up this video and start again tomorrow, is capital structure arbitrage. So capital structure arbitrage is a trading strategy. It's built around kind of options pricing models once again. And the idea is the debt and equity have traditionally got different investor bases, right? There's a different type of person who invests in the bonds of a company to the stocks of the company, and maybe they don't look at each other, they don't look at the other products. So the idea is that maybe using some sort of model that can compare the valuation of the stocks to the valuation of the bonds of a given corporate, we might be able to find a mispricing in there. And this is the idea behind capital structure arbitrage. Now, in truth, the guys who came up with capital structure arbitrage were all ex-convertible bond arbitrage traders, right? Because the convertible bond arbitrage strategy stopped doing very well, and a bunch of smart guys who were able to look for trading strategies, and they came up with this. And so this is kind of the newest, or one of the newer hedge fund strategies out there. It's been around for, I'd say, about 15 years, but that's a fairly new strategy. The firm, by the way, the capital structure, it's called capital structure arbitrage because the capital structure of a firm is usually made up of debt and equity. So a company is financed by issuing bonds and stock. And so that's the capital structure. So suppose we have a company and it's worth 100 million. So the overall company is worth 100 million. And the face value of the debt that's outstanding is 80 million. We can then think of equity as being like a call option on the firm's value, right? Because with a strike price of 80, right? Because the equity only has a value if the firm is worth more than 80 million. If it's worth 80 million or less, it's entirely owned by the bondholders, right? The equity goes to zero. So equity holders are long a call option on the value of the overall firm. That's a way of thinking about it. Now, equally, suppose the firm has the value of 100 million, so the total company value is 100 million. The debt's worth 80 million. We can think of debt as being like a short put option on the value of the firm. So that's two ways of looking at these two securities. And so once we're able to think, and it's reasonable to think about these two securities as being option-like, once we're able to do that, we're then able to possibly price them relative to each other using options pricing methods. So if equity is like a call option on the firm value, you can use the Black-Scholes model to back out the firm's implied volatility, right? We're able to back out the implied volatility of, now it's not the implied volatility of the equity stake, it's the implied volatility of the whole firm. Then we're able to use put-call parity in order to calculate the value of the put, which is the debt of the firm. And we can compare this price to the actual market price of the debt. So hopefully this is making a little bit of sense to you. If you don't know much about options, it is worth, I've got videos on put-call parity and even in what a put is and what a call is. So it's worth watching those. But anyhow, so this idea is that if we can view the debt and the equity as puts and calls, we're then able to price them relative to each other using the Black-Scholes model. So using the Black-Scholes-Merton model and the put-call parity formula, you can go back and forth between debt and equity calculations and compare the relative valuations. And then you're basically able to trade one against the other. You're able to go long stock, short bonds, or however it might be. You're able to say if one is over or undervalued relative to the other. So suppose the model indicates that bonds are pricing in a distressed outlook for the company and equity is trading as though the company is doing well. Then what you're able to do is you're able to buy the cheap bonds and you're able to sell the expensive equity and hope that the market just moves them back in line with each other. So you don't have to really have an overall directional view on the company. You're just saying that the two elements of the capital structure are telling different stories, and if they start to tell the same story, then the price will be back in line and a profit will be made. So there's a few scenarios. One, the company recovers, and in that case you'll make money on the bonds position and lose money on the short equity position. Scenario number two, neither recovery nor bankruptcy. And in that situation, you'll probably make money if the assets just move into line with each other. Scenario three, the company goes bankrupt and you can lose money on your long bonds, but make money in your short equities position. So this is kind of the idea behind this trade. Now, there are problems. It's not that easy a thing to trade. And the reason is that sizing them relative to each other in order to have a low volatility portfolio is quite difficult, and that's simply because they tend not to have clear and consistent betas to each other. Models might show historically that a 1% bond move accompanies a 10% equity move, and therefore you might hedge on a ratio taking that into account, but then that relationship can change as the company moves closer to bankruptcy or further away from bankruptcy. And so in real life, the relationships only sort of hold well in scenarios where a company is in distress, if it's near to bankruptcy. That's when capital structure arbitrage works. The rest of the time, the relationships don't hold very well, and for that reason you're just exposed to essentially risk without return, which is not an attractive exposure. So There's numerous ways, if you are a capital structure arbitrage trader, to express your views. And as you can see, this is a lot like convertible bonds, where there's a lot of ways to express your views. And so that is the end of today's class. Hopefully you've enjoyed it, and we'll be back tomorrow with our final class in applied portfolio management, and it'll be our final class on the topic of hedge funds. So talk to you then. Bye.